If you have $10,000 sitting in a savings account right now, you are losing roughly $300 this year, and your bank is making thousands off that exact same money. Here's what almost nobody tells you. The thing you built to feel financially safe might actually be the biggest thing holding you back from real wealth. By the end of this video, you'll have a clear, simple system to fix it, without taking crazy risks, without gambling your savings, and without losing sleep at night. But first, let's look at the math banks hope you never actually run. Right now, most traditional savings accounts pay somewhere between 0.01% and 0.5% a year. Sounds harmless, until you realize inflation is running at around 3%. That gap, that silent, invisible gap, is slowly eating your money alive. Let's make it real.
Look at this.
If you've got $50,000 sitting in a standard savings account today, in 10 years, that same money will only buy what $37,000 buys today. You didn't spend it. You didn't mess up. You did everything right. And you still lost $13,000. That's not saving. That's a slow leak. And here's where it gets even more frustrating. The bank isn't losing anything. They're taking your deposits, turning around, and lending that same money out at 7%, 10%, even 25% on credit cards. You're supplying the raw material, they're running the factory, and they're paying you almost nothing to make it all possible. Now, this is where most people make a huge mistake. They hear this, panic, and think, I need to throw everything into the stock market right now. That's not the answer either. Because here's the truth. You do need cash. Giving up all your liquidity to chase returns can hurt you just as badly as holding too much. So the real question isn't savings or investing, it's how much of each, and that's exactly what we're going to solve. There's a concept called opportunity cost, and it carries a price tag most people never actually calculate. Let's say you're playing it safe and keeping $50,000 in savings when you realistically only need $10,000 for a true emergency. That extra $40,000 just sitting there? It feels safe. It is not. If that same $40,000 had been invested in a simple index fund averaging 10% annually, over 30 years, it could grow to around $697,000. Think about that for a second. Your safe decision didn't cost you nothing. It cost you over $650,000 in future wealth. That might be the most expensive feeling of security you will ever buy. But here's the part that's going to frustrate you, because the reason most people don't fix this isn't greed or laziness, it's something much deeper, and once you understand it, everything changes. Most people are using their emergency fund as an all-purpose money pile, vacations, furniture, expenses they can see coming years in advance. That is not an emergency fund. That is just disorganized saving. Your emergency fund has exactly one job: to make sure you are never forced to sell your investments at the worst possible moment. Because here is the real danger. If the market crashes and you lose your income at the same time, and you have no cash, you're forced to sell your stocks at the bottom just to pay rent. That is how wealth gets permanently destroyed. It happens to real people every recession. I know that sounds scary, and it should. But here's the good news. This is completely preventable with one simple structure, and it takes about 10 minutes to set up. So I want to give you something most financial videos never actually give you: a specific number. Not a range, not it depends, your exact cash cap. I call it the Liquidity Ladder. 3 levels, 3 clear purposes, and every single dollar has a job. The first rung is your operating buffer. This lives in your checking account. About 1 month of expenses, just enough cushion so life runs smoothly. No stress, no overdrafts. You don't care about the return on this money. It's just the fuel that keeps your daily life running. The second rung is your actual emergency fund. And here's the key most people miss. Do not let this sit in a near zero interest account. put it in a high-yield savings account earning 4 to 5%. If you're single and renting, aim for 3 months of essential expenses. If you have a family, a mortgage, or dependents, go for 6 months. That's it. Not 12 months, not an endless just-in-case pile. 3 to 6 months, and then you stop adding to it. Because once that bucket is full, this is where it gets powerful. Every dollar beyond that moves to the third rung, your wealth engine. Tax-advantaged accounts, index funds, income-producing assets, things that grow, compound, and fight inflation instead of quietly surrendering to it. Now, if you're sitting on a large pile of excess cash right now and feel nervous about moving it, that's completely normal, and there's a simple way to handle it. It's called dollar cost averaging. You take your excess cash, split it into 6 equal parts, and invest one portion on the first of every month for 6 months. That's it. No guessing, no trying to time the market. You remove the emotion from the decision entirely. And here's the twist most people don't expect. If the market drops after your first investment, that's actually good for you. Your next transfer buys more shares at a lower price, lowering your average cost and setting you up for bigger gains on the recovery. Suddenly, volatility isn't the enemy, it becomes your advantage. But there's one more piece almost everyone overlooks, and it might be the most quietly damaging of all: taxes. The interest you earn in a savings account is taxed as ordinary income, the highest rate you pay. But here's a simple example to show you why that matters. Say you earn $1,000 from your savings account this year. Depending on your bracket, you might keep around $650 after taxes. But if that same $1,000 came from a long-term investment gain, you could keep $850, or in some brackets, the full $1,000. Same dollar amount, completely different outcome. So not only are you earning less in savings, you're keeping less of what you earn. The account type you choose is not just about returns, it's about how much of those returns you actually get to keep. This is exactly why wealthy people don't sit on large piles of idle cash. They understand one thing clearly: cash loses value over time, so they keep their money in motion, constantly moving into assets that grow, compound, and outpace inflation. So, here's what I want you to do right now. Open your bank account, look at your last 3 months of spending, and find your average monthly number. Multiply it by 6. That is your emergency fund cap. Anything above that number? That is lazy money, and right now it is not doing its job. Here's the uncomfortable truth. Keeping too much cash in the bank is a tax you're paying to your own anxiety, and unlike most taxes, this one compounds against you every single year. Real financial freedom doesn't come from a big pile of idle cash. It comes from assets that work harder than you do. So cap your cash, automate your investing, and stop letting inflation quietly steal what you worked so hard to build. Every month you leave that excess cash sitting there, you're making a choice. You're just not making it consciously. Start making it consciously today. If you want to go deeper and learn exactly how to build your investment portfolio once your emergency fund is set, I've got a video right here waiting for you. Go watch it. You've built the foundation. Now it's time to actually grow. Disclaimer: this video is for educational and entertainment purposes only and does not constitute financial advice. Always consult a qualified financial professional before making investment decisions.